What if I told you there's a Singapore bank stock that gives you solid dividends, strong growth potential, and costs half as much as its competitors? Yes, I'm talking about OCBC. And with the recent stock market dip, this could be the best time to buy. In this video, I'll show you why both new and seasoned investors should seriously consider OCBC right now, especially when compared to DBS and UOB. Stay with me till the end, because we'll break down the numbers, highlight the risks, and reveal why OCBC might be the smartest dividend play in Singapore today. And don't forget to like this video, subscribe to Wealth for You, and tap that bell so you never miss smart investing advice like this. Hey everyone, welcome back to Wealth for You. If you're building passive income or just starting out in the Singapore stock market, you're in the right place. Let's break down OCBC's latest financial numbers, compare it to DBS and UOB, and find out why OCBC could be your best move in this market correction. Quick disclaimer. This video is for education and entertainment purposes only. I'm not a licensed financial advisor, so please do your own research or speak to a qualified professional before making any investment decisions. Chapter 1. Why OCBC is a strong buy. Now, OCBC's share price dipped below 15 Singapore dollars recently, and for savvy investors, that spells opportunity, not panic. At that price, you're locking in a dividend yield of around 6.1%, based on their newly announced 60% dividend payout ratio. That's one of the highest among the three local banks and beats the returns of many REITs right now, especially in a high interest rate environment. But that's not all. OCBC also announced a 2.5 billion Singapore dollars capital distribution and a multi-year share buyback plan running through 2025 to 2027. Why does this matter? Because every time the company buys back shares, there are fewer shares in the market, which means higher earnings per share for remaining shareholders. And if earnings per share go up, and the payout ratio stays consistent, your dividend per share should also rise over time. In other words, OCBC isn't just paying you well now, they're setting up for higher shareholder returns in the future too. This is a textbook example of smart capital management that benefits long-term investors. Chapter 2. OCBC versus DBS versus UOB. The smart comparison. Let's look at how OCBC stacks up. Price per share. OCBC around 15 Singapore dollars, UOB around 33 Singapore dollars, and DBS around 40 Singapore dollars. For a new investor, buying one lot, that's 100 shares, of OCBC costs half or even one-third of what you'd need for DBS. That's a low barrier entry point. Dividend yield. OCBC around 6.1%, DBS and UOB slightly lower but solid. And remember, OCBC is growing its dividend without major integration costs, unlike UOB with Citi. Capital strength. OCBC's CET1 ratio is 17.1%, higher than DBS and UOB, meaning more buffer, more flexibility. OCBC also benefits from its diversified model, with strong contributions from insurance, Great Eastern, and wealth management. Chapter 3. Why it's great for beginners and income investors. For beginner investors, OCBC is almost a no-brainer. It has a lower price point compared to DBS and UOB, which means you can get started with a much smaller capital, about 1,500 Singapore dollars for one lot. That's a lot more accessible if you're just beginning your investment journey. The business is also easy to understand. Traditional banking, insurance, and wealth management, all pillars of a stable financial institution. For income-focused investors, OCBC offers something just as important: peace of mind. This is a bank that has consistently paid dividends through the toughest times, whether it was the global financial crisis or the COVID-19 pandemic. Even when the economy slowed down, OCBC kept rewarding shareholders. Their management is conservative in risk, but smart in strategy. Instead of hoarding excess capital, they've committed to distributing it through regular dividends, special dividends, and share buybacks. That's a clear signal. They're not just protecting your capital. They're working to grow it, responsibly and sustainably. Chapter 4. Final thoughts and why you should watch this stock. The recent market correction has made a lot of investors nervous, and that's understandable. But for those of us thinking long-term, it's actually opened up a rare buying opportunity. OCBC is in a strong financial position, offering both income stability and capital growth potential. Right now, it's trading at slightly above book value at 1.17, as compared to DBS 1.63 and UOB 1.16. As interest rates begin to soften, traditional banking margins might tighten. That's where non-interest income becomes critical, and OCBC is already ahead of the game. With diversified income from insurance, Great Eastern, wealth management, and fee-based services, OCBC is building a more resilient earnings engine. So whether you're just starting your investing journey or looking to grow and defend your dividend portfolio, OCBC offers a compelling balance of safety, yield, and upside potential. This isn't just a bank stock, it's a long-term wealth-building vehicle hiding in plain sight. If you made it this far, it means you're serious about your money. And I respect that. Give this video a big thumbs up. Subscribe to Wealth for You and drop a comment below. Are you buying OCBC or are you leaning toward DBS or UOB? Let's learn and grow together as a community of smart Singapore investors. Thanks for watching. And remember, stay calm, stay invested, and focus on becoming cash flow rich, not just asset rich. Like they say, net worth is vanity, but cash flow is sanity. See you in the next one.